Today we are going to discuss Chapter 24 and 24. Chapter 24 is about the responsibility accounting and performance evaluation. In that chapter we have many learning objectives. Actually, we would like to explain why companies decentralize and use responsibility accounting. 2. To describe the purpose of performance evaluation system and how the balanced scorecard help company evaluate performance. Use responsibility reports to evaluate cost, revenue, and profit centers. 4. To use return on investment and residual income to evaluate investment. 5. Determine how transfer pricing affect decentralized. The first learning objective is to explain why company decentralize and use. Small companies are most often considered to be centralized companies. When a company grows, it is impossible for a single person to manage the operation. Companies decentralized as they grow. This is why decentralized companies split their operations into different segments such as departments and divisions. The centralized companies means that one person is responsible for more than one of the responsibilities inside the company. But in the decentralized, and actually the centralized companies will be more suitable for, as we said, the small companies, because actually small companies does not need a lot of people to manage it in order not to create conflicts in decision. But in big companies, decentralization will be more useful, more beneficial, because actually the big companies are divided into departments and sections, and these departments and sections are in need for a specialized person in order to take the right. What are the main advantages of decentralization? First, to free the top management time in order to take strategic decisions, long-term decisions in the future. 2, support use of expert knowledge, which means, as we said before, in decentralization and for each section or department, whenever we are going to appoint some person for running that, actually we have to select the one that have the most experience in that field in order to make the best of his knowledge, use of his knowledge in order to take the right decision. To improve the customer relation, because actually whenever we have a specialized person that is responsible for one department, actually that will help to maintain. If you are talking, for example, about the customer care division, and we have a very skillful person that is responsible for that, actually this will improve the performance of that department, which is a very important department, and by default that will increase or enhance the customer relation with the company. Provide training. Yes, we have in the decentralized system, we have to provide training for all the people or all the sub-managers that are responsible for this department in order to increase their skills and level of skills, and to increase their involvement in the company. Improve motivations and retentions. This to be done through, of course, some of the compensation plans to be decided in order to increase the loyalty of these managers. What are the main disadvantages of the decentralization? Despite its advantages, decentralization can cause potential problems. Duplicate or duplication, of course, because maybe there is some intersection between the responsibility of two departments. Problems achieving goal congruence. The goal congruence occurs when segment managers' goal align with top management goal, and actually this is when we would like to align the efforts of all the departments with the goal of the top management. So actually maybe this is a problem to happen, which means maybe some of the department will have a different perspectives, different ways of running the things that may not to be aligned to the top management way of running the business. Responsibility accounting. Actually, responsibility accounting are needed when we are applying the decentralized system. because decentralized company delegate responsibility for specific decision to each subunit. So the responsibility center is part of the organization for which a manager has decision-making authority and accountability for the result of the decision. يعني whoever will be responsible for a department to take a decision, he is responsible for all the consequences that will come due to this decision. So this is to be called responsibility center. Each center, each department that has a responsible person that taking decision, this will be called responsibility center, and the head of that center will be responsible for the consequences of his actions. The responsibility centers, actually we have more than one responsibility center that we have to be aware of. The first one is the cost center, which is whenever the manager is only responsible for controlling the cost, and in that case we are calling him or calling the department or the section that he is responsible for cost center. Revenue center, and here as the name is implies, the manager is only responsible for generating revenue. Profit, the manager is responsible for generating revenue and controlling cost in order to achieve a profit, which means he is responsible for both, which means that center is including or the merge of the two previous centers. Investment center, the manager is responsible for the center's invested capital, which means the manager here is responsible for selecting the sound investment that the company will invest their money at. Here are some of the managers and the responsibility report. In the cost manager, in the cost center, we are controlling costs, which means we are doing a report that's showing a comparison between actual cost and budgeted cost. In revenue center, we are generating revenue, so actually we are comparing the actual revenue to the budgeted revenue. In the profit center, we are producing profits through generating revenue and controlling costs, so actually the reports that will be resulted from that center will compare actual revenue and cost with budgeted revenue and cost. The investment center producing profits and efficiently managing the center's invested capital. So the report, the responsibility report for that center, that we are comparing actual profit to budgeted profit and measure return on investment and residual income. Here is an organizational chart actually showing that this is the president or the chief executive officer of the company. We have a vice chief financial officer, which is the CFO. We have the chief operating officer, which is COO. We have also under the chief financial officer, the controller and the treasurer. The treasurer is the one that is responsible for the inflow and the outflow of cash. Controller is actually the one that is keeping record, and he is monitoring the payroll processing manager. On the other hand, the vice chief operating officer will have a tablet computer division manager, for example, software development, and we have standard tablets department manager, premium tablet department. Actually, this part is related to the type of activities to be performed by each company. So actually all what we are caring about here is to know that there is a chief financial officer and a chief operating officer. The second learning objective is to describe the purpose of performance evaluation system in any company and how the balance scorecard, and this is one of the most famous tools for performance evaluation, helps company to evaluate. What is performance evaluation system and how it is used? Once the company decentralizes operation, top management is no longer involved in running the subunits day-to-day operation. As long as you are following the decentralization system, actually will have a lot of subunits, and all of these subunits are in need for performance evaluation. So the performance evaluation is a system that provides top management with a framework for maintaining control over the entire organization, because as we said above, they are not able to maintain a full control or a full monitoring above all the other subunits that are not under their direct supervision. What are the main goals of performance evaluation system? The primary goals of performance evaluation system are promoting goal congruence and coordination, which means to make sure that all the units are aligned to the thinking or the strategies of the top management, and there is a full coordination between the lower levels of management and the higher level of management. Communicating expectation, because actually when the top management set strategies for long period of time or for a long run time, actually those must be communicated to others, and the performance evaluation will set that expectation, and they will identify to the other managers, so actually they can act in the same direction. Motivating segment managers, because whenever you are communicating expectation, you are setting some compensation, some motivation for the management in order to achieve this expectation. And by doing the performance evaluation at the end of the year, you are going to provide a comparison between the expectation and what actually have been achieved by the management, and this will provide them with a feedback, comparing this feedback with the benchmarking of the system, and this will result in the level of satisfaction of the result of that evaluation or not. What is the limitation of any financial performance measurement? The financial performance measure are lag indicator, which are revealing past performance, and the management or the managers need lead indicator as well. The lag indicator, this is like when you are calculating ratios for the financial statement of the previous year. This is lag indicator because actually are evaluating the performance of the previous year. But actually, if you are looking to the future, and this is what manager must do, they need a lead indicator, which means they have to have some indicators that help them taking decision in the future. So the financial performance measures have a short-term focus, so actually management or managers should have a long-term focus. As this is why some innovative tools must be used, like the balanced scorecard. The balanced scorecard is a performance evaluation system that requires management to consider both financial performance measures and operational, or in some other text, non-financial performance measures. Management use key performance indicators to assess whether the company is achieving its goals or not. And those key performance measures are divided into 4 different perspectives: the financial perspective, customer perspective, internal business perspective, and learning and growth perspective. If you can see here, this perspective, which is the financial perspective, are following a strategy that would like to increase the company profits through increasing revenue, growth, and productivity. How to measure the increasing revenue, gross productivity? You can use KPIs like net income, sales revenue gross, the gross margin gross, the cash flow, the return on investment, the residual income. All of those are key performance indicators for evaluating the financial perspective of the company, which its main strategy is to increase the company profit, revenue, and productivity. Second, the customer. The strategy here is to improve the customer satisfaction for long-term success. Actually, how can we do that? We can do that by customer satisfaction, rating. We can do it by percentage of the market share that we are acquiring, increase the number of customers, number of repeat customers, how many times the customer is returning to you again, number of customer complaints, rate of on-time deliveries, percentage of sales return. All of those can be considered as key performance indicators for the customer perspective. The internal business perspective is to improve the internal efficiency and effectiveness to achieve profitability and customer satisfaction through innovation, operation, and post-sales services. And this actually can be measured through KPIs, key performance indicators, like number of the new product developed, new product development time, manufacturing cycle time, defect rate, and the number of the unit produced per hour, and others rates, as you can see. The last one, which is the learning and growth, and this is, we are talking about retain skilled employee and to update technology and to create a positive corporate culture to provide a foundation for improved internal operations, sustain customer satisfaction, and generate financial success. And this is related to, as you can see, the employees by measuring their performance through hour of employee training, number of the cross-trained employees, percentage of computer downtime, and employee satisfaction, employee turnover, and other rates. So actually here in the balance scorecard, the 4 perspectives actually covered all the aspects of the company, including financial and non-financial measures. And this will help the company to evaluate its performance in a way that is complete and very insightful for the managers. Learning objective number 3, use responsibility reports as we discussed now in learning objective number 2 to evaluate cost, revenue, and profit. How do companies use responsibility accounting to evaluate performance in cost, revenue, and profit centers? Responsibility accounting performance report focus on responsibility and controllability. Controllability means we would like to show the responsibility of each manager and how his functions is controllable. The focus is only on what the manager has responsibility for and control over. The manager should not be evaluated on item he or she cannot control. Any event that is out the control of the management cannot be the responsibility of the management. So we have to determine to find out first what is under the control of the management. So evaluate the manager for taking decision relating to these items. Controllable versus non-controllable cost. Controllable cost is the one that the manager, as we just said, had the power to influence by his or her decision. If I'm going to rent that space, so actually I will pay for that rent. If I do not, then I will not pay. So actually this is a controllable cost. The upper level management has control over more costs than the lower level management. Of course, this is very logical because the top management will have more control over the costs, okay, than the lower management, and the lower manager have responsibility for a limited number of course, because actually this is the vice versa of what we just said in point number 2. The responsibility report. The responsibility reports are completed for the manager of each business segment, which means each management or each manager that is responsible for specific segment must prepare the responsibility report. Actually, the term responsibility accounting try to associate cost with manager who has control over, which means this report will make the manager stating what are the main costs that he is responsible for and how can we use that in order to evaluate his performance according to whatever he is controlling only. The cost center. As we said, we have more than one center. The first one was the cost center, and it focused on cost or expense, as we said before, and the focus on the flexible budget variance for each cost, and this part that we already covered in the previous chapter. Highlight the difference caused by change in cost, not by change in sales or production volume, because actually here he is concentrating only on cost. If you can see here, this is a performance report versus responsibility report for a cost center. This is the actual result, as you can see. And this is the flexible budget, as we discussed as in chapter 23. And this is the flexible budget variance, which is the difference between both actual and flexible. And this is the variance percentage. So actually here, if you can see, the salaries here are 3,000 actual and the budget was 3,000, so the variance is 0. Wages, we expected 15,000, actually 15,500, so we have 500 unfavorable. This is the percentage of variance, which is, we are dividing the 500, which is the flexible budget variance, over the flexible budget to get the percentage of variance. Payroll profit, the same, equipment depreciation, supplies, other expenses, which means we are comparing the actual to the flexible, then getting the variance in amounts, and then to get the variance in percentage to know exactly the percent of variance for each type of cost. Another one that is related to payroll processing department. Here we did the same, which means here we compare the actual cost again related to the wages and payroll, and we compared it with the flexible budget. We got the flexible budget variance and the variance percentage, as you can see. And this part, of course, related, as we said, for the responsibility, the payroll responsibility. Above, we performed that report in order to evaluate the total performance for the department. The revenue center, as we said previously, it focuses on revenue, and it focuses on the flexible budget variance and sales volume variance for the revenue. The sales volume variance is due to volume differences, selling more or fewer units than planned. The flexible budget variance is due to difference in the sales price, selling unit for higher or lower price than a planned. Seen here, because actually here I'm comparing the actual sales, okay, to the flexible budget variance. طبعا the flexible budget variance is the difference between actual and flexible budget. Okay, and we compare the flexible to the static budget, and this is again what we did in the previous chapter in order to get the sales volume variance. And this type of variances is related mainly to the revenue center, because actually we are concentrating on the number of premium tablets, which is the sales in units, and the sales revenue in the profit centers. It focuses on the generating revenue and controlling costs. So actually the report here would include both revenue and cost, and it focuses on the flexible budget variance for revenue. And as you can see here, this is the actual sales, variable expense, this is contribution margin, the fixed cost, and the margin. And as you can see here, we use the contribution margin income statement format. So actually here I'm going to compare the actual with the flexible budget variance, and the difference is in the flexible, actual to be compared with flexible budget, and the variance is flexible budget variance, and this is the percentage of variance as we explained. The only difference here, because we are talking about the profit center, that we included sales, revenue, and expenses. Again here, this one is for the responsibility report, not the performance report, as we said before. So actually here, as you can see, we compared the sales revenue actual with flexible to get the flexible budget variance, and this is the percentage, and the variable expenses, and then the contribution margin. Why here in the responsibility we stopped at the contribution margin? Because actually the contribution margin is one of the most important numbers that you can use in taking decision. This is why the responsibility report here is concentrating only on showing the contribution margin.